Welcome to the Monday edition of Tech Stocks Daily. We've got a lineup that'll keep you on the edge of your seat. First, we delve into CrowdStrike's chaotic week, battling a disaster update, lawsuits, and a 44% stock plunge. Yikes. Then we'll jump into AppLovin's sky-high earnings expectations and the potential roller coaster that awaits. And finally, we explore Microsoft's strategic gaming moves and their Azure stumble. Fasten your seatbelts and let's tackle today's tech storm together. Hey tech fans, it's time to dive into today's headline story that's shaking up the cybersecurity world. CrowdStrike is currently front and center in a whirlwind of lawsuits, stock dips, and reputational havoc. Let's break down exactly what's going on with this NASDAQ-listed company. The Falcon falter. First, let's set the scene. CrowdStrike, a major player in the world of cybersecurity, found itself in hot water following a disastrous software update in July. The company pushed an automatic update for its flagship Falcon sensor, a tool relied upon by countless organizations to keep their systems secure. But this update turned out to be more of a trick than a treat. The update contained a bug that triggered a colossal overnight outage, affecting a staggering 8.5 million Windows computers. Businesses from banks to broadcasters found their operations crippled, with many systems crashing and showcasing the dreaded blue screen of death. Ouch. Legal storm. Now this isn't just your standard IT hiccup. The fallout from this mishap is epic. Investors who suffered massive losses aren't taking this lying down. Multiple law firms have jumped in to represent these aggrieved shareholders in class action lawsuits. Hagens Berman and Levi & Korsinski are two of the heavy hitters urging investors to step forward and recount their losses. Both firms are digging into allegations that CrowdStrike falsely assured stakeholders about its Falcon platform's resiliency, yet lacked proper testing procedures, creating a breeding ground for such a massive failure. The lawsuits allege that due to the botched update, CrowdStrike misrepresented its product's safety and efficiency. As a result, many are facing big-time financial hits. We're talking losses that have triggered serious legal action and driven down the stock price by a dramatic 24%, shedding $84.24 per share. If that wasn't enough, Delta Airlines is suing over damages caused by the update that led to over 6,000 flight cancellations. Oof, talk about a nosedive. Stock speculation. With shares plummeting 44% in July alone, it's been a rough ride for CrowdStrike investors. The company's valuation took a massive hit, with market cap losses inching close to a brutal $30 billion. Now, despite this painful episode, is it all doom and gloom? Maybe not. Some analysts suggest this deep dip might be a buy-the-dip opportunity, if you dare. Before the nosedive, CrowdStrike was sporting a steep PE ratio of 437, indicative of investor frenzy bidding it up ahead of true earnings growth. Even battered and bruised, CrowdStrike remains a major player in the lucrative AI and cybersecurity market, with annual recurring revenue rising 33% to smash past $3.65 billion. There's still a huge market potential, which means that while some may be spooked, others are eyeing a long-term recovery similar to Equifax after its data breach disaster. What's next? So, what's on the horizon for CrowdStrike? Tons of soul-searching, lawsuits, and possibly a long haul to regain its standing. Exit analyst hopefuls left wondering how quickly and effectively the company can patch up its reputation and resume normal business. With layers of lawsuits and regulatory scrutiny on deck, it's about to be a fascinating watch. Will investors stick it out for a potentially longer turnaround, or will CrowdStrike's faults fester, fueling further ebb and skepticism? Only time and a keen legal team will tell. That's the big scoop for today. Stay tuned as we continue to follow this evolving story. Hey tech enthusiasts, buckle up as we dive into why AppLovin is making waves today. So, the eagle-eyed stock analysts among you might have noticed that AppLovin is getting a lot of attention ahead of its Q2 earnings report, set to drop on August 7th after the market closes. And boy, the anticipation is palpable. Let's break it down. The Zacks consensus estimate forecasts AppLovin's quarterly earnings at 74 cents per share, a jaw-dropping 236.4% surge compared to the same quarter last year. Just to sprinkle on some extra optimism, they're also expecting revenues to touch $1.1 billion, marking a 43.8% year-over-year growth. Seriously, those are some impressive numbers. AppLovin has a knack for turning heads with its earnings surprises, crushing estimates for 4 straight quarters with an average surprise of 60.9%. Imagine getting 60.9% more cookie than you thought you were getting. Yeah, that's the kind of delight we're talking about. What's driving this incredible momentum? For starters, AppLovin's software platform, bolstered by its awe-inspiring Axon 2.0 technology and expanded gaming studios, is doing some serious heavy lifting. The platform's revenue is expected to witness a staggering 70% year-over-year growth. On the app side of things, the revenue is expected to grow by 8.3%, which is still nothing to scoff at. Moreover, analysts are showing some serious faith, reflected in metrics like an adjusted EBITDA pegged at $507.3 million, suggesting 86% growth year-over-year for their software platform. However, caution is the name of the game. Even superheroes have their kryptonite, and AppLovin is no different. There's buzz about potential slowdown risks in in-game advertising growth rates, and whether Axon 2.0 will keep delivering those wow results. Speaking of roller coasters, let's talk stock prices. AppLovin didn't just rise, it soared by 72.5% year-to-date, But here's where it twists. It plummeted 10.6% in the past 3 months and 20.8% in the last month alone. This up and down dance hints that the stock is currently in a correction phase. Some deep dip divers are speculating that it's now in undervalued territory, offering a potential entry point for discerning investors. But here's where the plot thickens. App developers and investors should also watch AppLovin's non-gaming ventures. They've been partnering up with the likes of e-commerce platform Flip and acquiring Whirl, which offers performance marketing channels in the connected TV space. Will these initiatives skyrocket their growth outside the gaming sphere? Only time will tell. In summary, AppLovin is riding high but walking a tightrope. With stellar year-on-year improvements and some exciting innovations in the pipeline, it's hard not to be optimistic. That said, potential investors should stay vigilant, considering risks like digital advertising slowdown and the unpredictable success of new initiatives. So techies, keep your eyes peeled. Whether it's a superstar leap or a cautionary tale, AppLovin's next dance move is shaping up to be an exhilarating watch. Stay tuned for more tech news and updates. You don't want to miss what's next. Hey tech enthusiasts, buckle up because today's segment is jam-packed with juicy tidbits about Microsoft, one of the titans of the tech world, doing all sorts of interesting things. Are you ready? Let's dive in. First up, Microsoft made headlines today as its subsidiary Blizzard Entertainment announced the launch of a new studio. According to Windows Central, this studio will focus on developing mid-tier games and integrating mobile elements into its popular franchises like World of Warcraft, Overwatch, and StarCraft. What's intriguing here is that this new studio will be stacked with ex-employees from King, the mobile giant also under Activision Blizzard's umbrella. Could this be a part of a broader strategy to push Blizzard games to mobile platforms, potentially creating new RPGs, strategy games, or even MOBA hybrids? It's all very hush-hush for now, but one thing's for sure, Microsoft is recalibrating its approach to the gaming industry, navigating cost-effective methods to foster innovation. News item number 2, Investor's Lens. Microsoft's market performance takes center stage. An article dissected Microsoft's key financial metrics and how they stand up to its peers in the software sector. Here's the gist. Microsoft's PE ratio sits slightly below the industry average, hinting at growth potential. Its price-to-sales ratio, however, suggests a touch of overvaluation when stacked against competitors. Earnings before interest, taxes, depreciation, and amortization, and gross profit are through the roof, with EBITDA being a staggering 51.24x above the industry average. The good news doesn't stop there. Microsoft's revenue growth is also outperforming peers at 15.2%. And when we sum this all up, it looks like Microsoft is not just a massive cog in the tech wheel, but also a well-oiled machine pulling ahead of rivals. And now for a dollop of drama. The tech giant experienced a minor hiccup as Azure, its cloud computing business, came up a bit short on revenue expectations, leading to a drop in stock. Even with disappointment hanging in the air, data showed a 29% year-over-year revenue growth for Azure, nothing to sneeze at. Microsoft's other segments, like productivity and business processes and more personal computing, also showed resilience and growth, left, right, and center. They also project healthy double-digit growth for fiscal 2025. Yes, infrastructure constraints have put a tiny dent in Azure's forward march, but collaboration with companies like Oracle and Cohere should help pave the way for a bolder Azure AI future. Long story short, Microsoft is a beast, navigating growth, leveraging acquisitions, and overcoming fiscal roadblocks with strategy and finesse. This tech behemoth is well poised to ride the AI-driven wave, sorting infrastructure hiccups merely as temporary setbacks. So, what do you all think? Is Blizzard's mobile integration pivot a game changer? Do Microsoft's financial metrics hold more promise for future growth, or are they red flags for you? Drop your thoughts in the comments. Let's geek out together. Plus, make sure to hit that like button if you enjoyed today's breakdown, and share this with fellow tech aficionados. Until next time. All right, tech fans, let's zero in on CrowdStrike, given the roller coaster it's been on today. So the big question, should you sell, buy, or hold? Buckle up for my take. CrowdStrike is undergoing a PR and financial nightmare due to that disastrous software update. A 44% dip in July and classes of lawsuits isn't exactly giving cozy vibes, but here's why I'd consider this a buy for the bold out there, and a hold if you're already in. Buy for the bold. 1. Market position. CrowdStrike remains a leading figure in cybersecurity and AI, a sector screaming for growth. Even amidst this mess, they've got annual recurring revenue skyrocketing at 33%, now topping $3.65 billion. 2. Valuation drop. The PE ratio was over 437, meaning investors saw loads of future potential. Shares getting knocked down by 44% could present a buy the dip prospect if you believe they can rebound like Equifax post-data breach. 3. Legal mitigation. Law firms are all over the issue, and while lawsuits are never pretty, companies in tech do manage to emerge stronger. If CrowdStrike can transparently address these issues and take steps for damage control, these stock prices could soar again, making current prices a bargain. 4. Innovation continuation. Their Falcon platform is still a robust asset. Improving and innovating, if done effectively, might recover trust and solidify market standings. Hold for the current investors. 1. Stable ground. Dumping shares now means you're locking in those losses. Holding could at least safeguard the potential of rebounding if CrowdStrike manages to navigate lawsuits and fix system trust. 2. Market recovery. Given the sheer numbers and current stock analysis, holding through the storm while CrowdStrike regains footing might be rewarding. Remember, we've seen companies bounce back in similar online mishaps. Pro tips. 1. Risk appetite. Assess your risk tolerance. If high stakes are your playground, buying in could reward generously, but it's a high-stress zone. 2. Market trends and analytics. Keep an eye out daily. Follow updates on legal proceedings and payout feasibilities. Look ahead in cybersecurity innovations and competitor moves. Reminder, always do your due diligence, crunch those numbers, and consult with financial advisors or do in-depth personal research. Your thoughts, questions, and perspectives are welcome. Hit those comments and let's geek out together. Today was a whirlwind, folks. We've seen CrowdStrike grappling with a nightmare of lawsuits and stock dips, AppLovin gearing up for a highly anticipated earnings report amidst a roller coaster stock ride, and Microsoft making strategic moves while hitting a few bumps with Azure. Hang tight and keep those notifications on because we're navigating some dynamic market waters here. If you found this breakdown helpful, don't forget to like, subscribe, and share this video with your fellow tech enthusiasts. And definitely come back tomorrow for another action-packed update. See you then.